Good morning, ladies and gentlemen. This is Clueless 8, and it's the 22nd of March, 2016. A quick but important pre-market AM broadcast on current market conditions and some global events that are pressuring the markets at least this morning. We have had a terrible terrorist incident again in Belgium, which seems to be quite the hotbed of radical Muslim terrorism, and and despite the capture of the ringleader of the Paris attacks just in the past 48 hours, it seems like this is another revenge attack. Well, we pray for all the victims and all the innocent people who are unfortunately caught up in that situation. You all be safe out here, and I believe that our authorities and our federal agencies will do whatever is necessary. Let's get straight to the markets. Futures currently are down about 8 points. Generally, what we find during these type of events of global turmoil, especially terrorist events like we saw with the Paris attacks, the markets pull back to some technical levels and then they bounce from there. There is a psychological reason behind it, and part of it, from what I've seen over the years, I'm a survivor of the 9/11 attacks, um, and is that we don't want to show capitulation and submission in front of those who want to harm us. It's really as simple as that. You don't want to buckle and say, I'm going to run. You want to stand up and fight. So the economic forces that be, which are manifested in the financial markets, also like to show that type of determination and resolve and not crash and burn. So, a simplistic way of looking at it, that at this point, oh my God, everything's going to fall apart. Well, generally doesn't happen, but if there are some successive attacks, obviously that's a different story. Saying all that, I wanted to show the picture of the E-minis right now and what's going on. I have put out some very tactical charts over the past couple of weeks, and like to remind everyone that we have had some humongous successes. My family life has taken a turn for the hectic, um, and for now, and I haven't had that much time to put out the end of the day reports like I normally do, but I do intend to be back in routine and producing at least a minimum of 3 end of the day reports or pre-market AM reports starting next week after Easter. So, saying all that, there are some extremely important video casts that are out there, and everything that I talked about and forecasted weeks ago, and in many cases off the bottom, have come to fruition. My tactical charts that are posted during the day should give you the roadmap that you need to effectively manage your trades. So, going into what we see here with the markets, it's a very symmetrical pattern that we're seeing. We have rising wedges, we have falling wedges, and now we have a rising wedge. The upper end of the rising wedge coincides around 2100. Just giving you some broad brush pictures here. This is the E-minis, obviously, so you have to add 5 or 6 points to that to arrive at the S&P 500. So extreme max case scenario, we make, we get back towards about, 2110, 2120. Well, I'm not even going there right now. What I'm looking at really is on this particular move, which I've shown many times, but right now showing on an interactive basis on the video cast, is a move towards 2075 that translates to about 2080 on the S&P 500. This was a point of maximum pressure, a sudden reversal after almost 5 days of or 4 days of a consolidative move, which should have gone. And these are the black swan events that happen. If you look at this was a dragon bullish pattern. So dragon bullish pattern should have resolved itself at least on the upper end of the scale, right? So similar to what's going on here. This is a very large dragon bullish pattern, and on a perfect scenario, it should get up there. Now here is where my contrarian thinking comes into play. Maybe we don't get to 2080. Okay, just the way we didn't get up here and test and complete this pattern, it's possible that this pattern doesn't get completed and this remains up in the air. Remember, if a washed kettle never boils, just the way everyone was screaming bloody murder and that we were going to go down to 1700 and 1600 and God knows what, it didn't happen. So they're giving you the psychological behavioral game theory aspect of what's going on, right? So we don't always have to hit that exact mark. However, if we do hit it, the chances are we're going to basically overshoot and get to 2100. Given the seasonal factor, what's going on, given that we're coming into a very powerful, we only have 7 business days left, okay, including today, to complete this month. And the fund managers with the $1 trillion, 800-pound gorilla in the room are going to make sure, in my opinion, a very high probability event that they are going to go ahead and post March in the low single digits as a first quarter return. If that's the case, then selective stocks, mind you, selective stocks are going to basically move higher from here. And also keep in mind that we have had that certain sectors are starting to show some grit. Energy, biotechs beaten down. Techs have been weakening a bit, to be honest with you, other than Tesla. So we have to be careful about that. Selective stocks I'm putting out there in different sectors, and they're doing extremely well. And some of you who are, and many of you who are participating in it know exactly what I'm talking about. So saying all that, we might not get to 2080. Then what? Well, then comes the retracements. I will do a full retracement stuff that I've shown on my Algo HFT charts, on bar charts, which I posted several times. And looking at this here, let me just show you the E-minis. 1 second. Get out of here. Okay. So let's say we're looking at this. All right. So that's the broad baseline. What about if we do this? So if we do this as a minor wedge within the large rising wedge, within the large rising wedge, then you see what goes on. 1 second. Okay, perfect. So right there. So if you look at this here, that's also very symmetrical. So that means we are right there, and we should end. We probably are pretty much on the top end of the scale right now, and a pullback. Now the pullback, a max pullback in this, in my opinion, at this point would be test of this breakout line. You can see that what I'm talking about. This is this white line here was your breakout level, right? Look at that. A doji, confusion, and then bang. Then a retest, 2 days of consolidation, held the uptrend line, and then took off, right? So is it possible that this pattern symmetry, there you go. It's like a sine wave, right? Sine, cosine, you know what I'm talking about. So so it comes down to somewhere around that low 2000s. To be exact, we're looking at 2009, so like 2014 on the S&P 500. 2014 from here where we closed at 2052 or so. You're talking about 30. You're talking about 38 points, right? 2015, yeah, 50. My brain's not working today, so I'll just do this. I just want to get to an exact number. So we have, yeah, so like I said, 37 points. So if you look to see, you're talking about a 200 plus point pullback to basically test this area. Once you test this area, the market probably bounces again. If we break that, then things start to go a little bit, the trend change starts to take place a little bit. Now, no real trend change takes place unless we break S&P 1700, and that would be this line here, right there, okay? That's the E-minis, so it translates into S&P 1970. Once we break that, that's a different story. Then we have another level of contact here in the 1920 level on the E-minis. That's roughly about 1926 on the 1926 on the S&P 500. That would be the full engagement of this large and a mean reversion, right? And we'd still be within this uptrending Bollinger Band. That's another thing that I wanted to show people. Okay, that if you look to see the shape of the Bollingers, notice all these factors. Look what the Bollingers are doing. This is the white line. The Bollingers are moving up. So at this point in time, we're in the upper end of the Bollinger. Max, I've already explained all that stuff. The standard deviation from the 50 and since the crossover happened here, and I explained that way back in my video cast. So now that the crossovers happened, we have uptrending 34 in the 50-day moving averages, and the bottom line is that there's a gap here, and that's called the standard. That's the standard deviation is probably 1 or 2. Just the way the standard deviation here was away from the moving averages was the same, you're starting to see that we are getting up there. So once you do that, there should be a mean reversion, but the mean reversion doesn't necessarily have to come and test the lower end of the Bollinger. These are rising trend lines, so they could basically come down and test here. But one with the other, we will be getting a pullback. No question at whether it starts today, or whether it starts at or about when window dressing's ending next week. We don't know yet. Or it could very well, in my opinion, the real sort of pullback starts on the week before April 15, tax day. That's when we get some substantial pullbacks. In between, we get tactical pullbacks. All right. So let's get this out of here. Wanted to show you something here which should be behind this. Okay, it is. Okay, this is a swing 533 chart, and this is very interesting because I look at this on the side to get a view. It's a very simple chart, but reading it is a different story. So if you look at this here, spend a couple of minutes, we're getting quite overbought. I said weeks ago that this might be a situation very similar to what we saw back in back in August and September of 2015, which is back here somewhere. All right, you can refer back to my video cast to understand that stuff. It's the same pattern symmetry, and that we could stay overbought for a while. Well, that's pretty much what's going on. Now, on pullbacks and stuff, what happens is this line comes down, tests the 70 level, the upper end of the RSI band, and then it bounces from here. On a, let's say, 100, 150 type point pullback, you come and test the 50 RSI, okay? And if the market is still going to uptrend, then it bounces from here. On a consolidated pullback like we saw here, doesn't look much, right? When you look at the screen, look what happened. We went straight down, went below 30 on the RSI. This is a simple RSI, buy below 30 and sell above 70, that type of stuff. And then on a protracted pullback, which lasts a bunch of days and it feels like the world's going to end, this is what it does. Okay? So I've trained my eyes to study this for years now, and yeah, I think I read it pretty good. At this point, we're at R2. So again, I'm exercising caution. I'm not going out there going crazy with large positions. I'm doing tactical bets, and they're working fine. Because you're at R2 here. Remember, technical analysis is not foolproof. It's not like 1 + 1 = 2. So don't think that this is a perfect thing to look at. So I mean, that numbers have to match exactly. Bottom line is we're in the upper end of the scale, so you need to basically start phasing out of your larger positions. Remember, real burst also comes when you get to this stage here. I put out a Twitter feed out there, an article, a fantastic one, where they basically talked about how, it builds up. It's like momentum, right? When something's falling, it's falling, and all of a sudden it just crashes. And on the upside, it's the same story. It's rising, 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 and then it just goes. That's just momentum, the way, things work. So saying all that, if you look at where we are, this is a rising wedge, just drawing out the thing, and rising wedge is correct. So you will get a correction, and the correction will head towards 2000, which is a round number, which also happens to be the R1. So it's not rocket science. It's how you time these things and how you manage your trades is really the issue here. If somebody gets too early short, I mean, it's not a nice feeling. I still have a few of those S&P puts as a hedge, and they just didn't do anything. And today, I'll probably get paid on those. So the bottom line is that I'm looking at the future of the markets here in front of me, and I'm not seeing anything like, the U.S. markets are just like it's a regular day, at least price-wise. Anything can happen. Only price line is down 33 points because it's a direct correlation of what happened, terrorist attacks and airlines and stuff like that, right? Google's down 3, it's nothing. Tesla's down 82 cents. Apple's down 31 cents. So it's like, I'm not saying just throw away everything that happens on a terrorist incident. There could be ripple effects, which could be black swan events that we don't know about. I'm just saying, based on this particular incident that happened this morning in Brussels, um, it's not like the markets are freaking out for reasons that I explained to you. So saying all that because it has to have an economic impact, and that's what markets fear. Um, so at this point in time, going back to this here, we are overbought. We might move a little bit sideways, like I explained, as we get into the window dressing stuff, and then it's just going to suddenly drop. That sudden drop can happen in the middle of the night, which is we've seen a zillion times, where the markets basically open down 20, 30 S&P points for whatever reason. Okay, global reason. Could be currencies, could be a political event, could be primarily an economic event, interest rate event, a central bank event, whatever the case may be. So just be careful at this level. That's all I'm going to say. All right. Histograms are moving sideways, so the buying pressure has remained constant. Obviously, here it was very high. We're starting to see when it gets like this, obviously that's deep, deep anxiety. You know what happens in the chat rooms. Everyone's just like, where's the bottom? All kinds of stuff. So here we made the second bottom, but look what the positive divergence was. The histogram, which is a measure of the selling pressures, MACD histograms, did not collapse down to the same levels, even though we came and tested 1800 again, right? In hindsight, you got to learn these things. And if you don't learn and practice, you're just never going to do it right. So here there was a major positive divergence because the selling pressure was far less. I showed all this stuff way back, and then lo and behold, the market just takes off. All right. In the meantime, we get deep oversold with a minor correction. Look at that. The stochastics came crashing down, and it looked like the end of the world with just a one-day correction of maybe a 300-point type of correction. Okay, now let's take a look at the weeklies because that's going to shed some interesting light into what's going on here. And I've mentioned this before. I don't think I've shown it. So here's your weekly chart here. So what the weekly is telling us, and this was the 29, I kept on saying this market's going higher because I kept on looking at the weekly because if you get to these points here, where's that drawing tool? Okay, you get to these points here, it is going to go positive. This is better forecasting than anything you know out there. I'll tell you that right now, okay? I knew that on a weekly basis that the markets would have a couple of weeks. So look at this thing. This was the first week. If you want to take this as the first week, 1, 2, 3, 4, 5, 6, 7. I say on the 8th week, we peak and make it substantial tradable top. Pulls back, retest, tries to retest that on the first week of April, fails, and then we have a real correction. 8, okay? 8, on the 8th week, I believe the markets will basically form a powerful tradable top. But if you look at this here, the histograms were going to go positive. If that's the case, we are on the 3rd week of the histogram going positive. No one's saying here we stayed negative 1, 2, 3, 4, 5, 6, 7, 8. It's always 8, right? 8, 9. So is it possible that we stay up 9 weeks in a row? Or do we count this bottom as the first week? In that case, we are at 1, 2, 3, 4, 5, 6, 7. Whichever the case, there's many different ways to look at this stuff. And we are starting to peak, no question about it. You can see that. You can see the extensive weekly overbought conditions as money pours in for all the different reasons that we know about. A short squeeze plus some new money and all kinds of stuff, but a major short squeeze, a global short squeeze, oil stabilizing. Bottom line is this at one point will correct. When weekly RSIs correct and weekly histograms start to come down, that's when you get those like a week-long or multi-day or multi-week corrections. Okay, we'll see. But at one point, this will correct. There's no question about it. So I've laid out everything. Listen to it carefully. Manage your positions effectively. There's a lot of opportunities even in down markets, not just through the short hedges, S&P puts, RUT puts, and UVXY and stuff like that, through many other stocks which don't necessarily are correlated with the market. And I wish you all well. Thank you for listening.